Well, we do have some breaking news on Canada's economy. The inflation numbers from November have just crossed, and it does look like inflation was unchanged year over year at 3.1% in the month of November. Now, the estimate was for that number to clock in at 2.9%. So inflation in November holding unchanged at 3.1%, giving perhaps the Bank of Canada reasons to remain in hawkish tone for longer if they wish, while holding rates at their highest level in 2 decades. The consumer price index overall, as I mentioned, up by 3.1% in November compared to a year ago. That matches the increase we saw a month earlier. This is based on StatsCan data. It is faster, as I mentioned, than the median estimate on Bay Street, which clocked in at around 2.8%. When Bloomberg surveyed economists. On a monthly basis, the index was up 0.1% versus expectations for a decrease of 0.1%. So 2 key yearly inflation measures that are tracked closely by the Bank of Canada and filter out components with more volatile price fluctuations, the so-called trim and median core rates. Those were unchanged, averaging just below 3.5% year over year. That is faster than what economists were looking for. And then there's another key measure, a 3-month moving average of underlying price pressures. That fell to an annualized pace just below 2.5% from almost 2.9% a month earlier. This is all based on some of the Bloomberg calculations, but these are important metrics to watch. In the case of the Bank of Canada Governor Tiff Macklem, he has said policymakers are tracking that closely to better understand inflation trends. Now, just getting a little deeper into the specifics here, mortgage interest costs remain the largest upside contributor to the consumer price index. If you think about it, folks, we've seen higher borrowing costs because of higher interest rates, so that is an inflationary factor. With the inflation rate excluding those costs sitting at 2.2% for the month of November, excluding shelter costs entirely, the figure is 1.9%. All that said, these numbers could represent somewhat of a setback for policymakers after they held the central bank's overnight rate steady at 5% for the third straight meeting last month. We're going to continue to watch some of this market reaction to the inflation numbers coming up. We are also going to get some great perspective. Craig Alexander, former chief economist at TD Bank and Deloitte, will be joining us to talk about it. In the markets this morning, where the mood over lower interest rates in 2024 has been fueling stocks, we are currently looking at some positive performance right now, and we'll have full market coverage coming up. We've got Sadiq Adatia from BMO Global Asset Management joining us at the top of the 9 o'clock hour, and Philip Peterson from IG Wealth Management will be with us as part of our opening bell coverage here on the Open. All that coming up. Let's dig deeper into some of the stories we've been tracking this morning in our newsroom. Canada's Environment Minister will outline today the details of a plan to eventually phase out the sale of gas-powered vehicles in Canada. The new rules will require auto manufacturers to ensure at least a fifth of the vehicles they offer for sale in 2026 are fully electric or plug-in hybrids. And by 2035, all of the vehicles offered for sale in Canada will need to be zero-emission vehicles. Google has agreed to pay $700 million and allow greater competition in its Play App Store. This is part of an antitrust settlement with states in the United States. Most of the money will go into a settlement fund for consumers, and eligible users will receive at least $2 apiece. They may get additional payments based on their spending on Google Play. As we watch the central bank story here in North America, Japan's central bank has left its ultra-loose monetary policy unchanged for the 65th meeting in a row. The bank says uncertainty over the economic outlook is extremely high. The bank hasn't seen signs inflation is on its way to meeting its target. The rate decision has sent the yen lower in currency trading so far today. Let's come back to that story of stocks in North America, and the U.S. futures are pointing to a modestly positive start. Now, the S&P 500, with the recent rally, is up about 23.5% this year. It leaves it just over 1.1% away from its all-time high. The Dow Jones keeps hitting records, and after a 42% gain this year, the Nasdaq is starting to get people talking about 15,000. The TSX rallied 93 points, rising for the third session in the past 4 yesterday. Month to date, the benchmark is up 1.9%, which trails the S&P. But since the October lows, the Canadian market has enjoyed a 10% gain. Quick look at what's happening in the oil market this morning, where we are looking at WTI a little bit higher, pretty much flat. 72.50 is our current trade. On the gold front, quick look at what's happening with bullion, which is also higher, very modestly so, at $20.44 an ounce. U.S. and our loonie, which right before we got that inflation data was trading at around 74.78. It has strengthened a little bit against the U.S. dollar. We're now trading around 74.92 U.S. And I do want to come back to the inflation numbers that we got. So inflation unchanged in the month of November at 3.1%. Does this give the Bank of Canada a reason to stay on the sidelines, remain hawkish in its language when it comes to the interest rate outlook from here? Let's ask Craig Alexander. He's former chief economist at TD Bank and Deloitte. Craig, nice to see you. What's your immediate reaction to that inflation data?
Well, obviously, it's a bit of a disappointment in that there was expectations that we're going to continue to see some cooling in inflation. I don't think it's really going to have a large market impact, although the fact the Canadian dollar is a little stronger is probably a reflection of markets thinking, that these inflation numbers paint a picture where the Bank of Canada might remain on hold a little longer than the Fed. And obviously then from a short-term interest rate spread point of view, that's supportive to the Canadian dollar. And
the big story, I guess, over the last week was that you got an indication from the U.S. Federal Reserve that interest rates could be coming in 2024. Now, Bank of Canada Governor Tiff Macklem said to BNN Bloomberg's Amanda Lang that at some point in 2024, it's likely we are going to see rate cuts. But I guess you're saying at this point it depends on where
it's all about the timing, right? And the comments from the U.S. Federal Reserve has been very bullish and obviously has had a huge market reaction. And markets, in my mind, markets are getting a little ahead of themselves in terms of how much easing they're pricing into the market in the United States. In Canada, Tiff Macklem has been more cautionary, and the inflation numbers, in a sense, back up that cautionary point. I think that it's clear that interest rate rises, I think, are off the table. What we're really debating about is when will central banks cut rates, and I think that the Bank of Canada will want to see real definitive evidence that core inflation is heading down to the 2% mark before they actually start to really provide any interest rate relief.
And can you explain I mentioned just a couple of minutes ago, there's different components to the inflation data, but a lot of times we hear about this so-called target range for the bank of around 2%, but they also have this control range between 1% and 3%. So as an economist, what kind of numbers would you be looking for that would be a clearer sign of inflation trends cooling?
It's really the 2% midpoint target of the 1% to 3% range that the bank focuses on. You could argue that once you've got core inflation on a sustained basis below 3%, the Bank of Canada could be easing. But I think the Bank of Canada is going to be cautious about this. There is one wild card, though, which is different this time around, and you highlighted it in your comments around the fact that if we remove the impact of shelter costs, specifically mortgage rates, the rate of inflation is only 2.2%, and that is interesting in that will the Bank of Canada see through its own impact on inflation, because those higher mortgage costs are coming from the prior Bank of Canada rate hikes. You could argue, and I would contend, I would agree with this, that you should treat it like an oil shock. And the Bank of Canada often looks past an oil shock in terms of what's happening to underlying inflation. And so I think that that's one of the key things here is, will the Bank of Canada will it focus on its preferred measures of core, which is the common, the trim, the median, or will they factor in the fact that the only reason inflation is well above target is because of the interest rates that they imposed on the economy?
And should we if we're talking about inflation, should we also talk about stagnation? Because there have been some signs of a cooling Canadian economy, and obviously, there's these different inputs to inflation. Maybe they look through mortgage-related costs, but are you concerned about stagnation?
Well, I think what's happening is the Bank of Canada raised interest rates to dampen demand, and the fact that we're seeing weak economic numbers, particularly on the growth side. The fact that we're seeing weak growth numbers suggests that they're being effective at tempering demand. And in fact, that will bring about the eventual drop in interest rates. The real debate, though, is is it going to be April or is it going to be June? I personally would bet that we're probably looking at rate cuts in the summer as opposed to the spring. But that's my personal perspective.
This is the first of two inflation reports before the Bank of Canada's next rate decision. That is in January. And right now, it looks like the majority of the economists on Bay Street are still expecting that to be a period of wait and see or hold or whatever. You would agree with that for now, then?
Oh, absolutely. I mean, I think that it's going to be several months before they entertain thinking about lowering interest rates. And a lot will depend on how the economy performs. It contracted in the last quarter. And we'll see, right now we're tracking towards a pretty flat reading in the fourth quarter. So if we get more downside on the economy, I think the Bank of Canada will cut sooner. If, on the other hand, inflation proves to be sticky and the economic weakness isn't a contraction, but rather is very flat or very meager growth, well, then I think the Bank of Canada will stay on the sidelines till they're convinced that core inflation's around 2%.